Welcome to Talker Tickers. Today we're digging into ING's Q2 2025 earnings, and folks, this one is a really interesting puzzle.
All right, so let's get right to the heart of it. On the one hand, you've got ING posting a really clean earnings beat, 56 cents per share when the street was only looking for 51. Solid, right? But then you look at the market's reaction, and it was, well, a total shrug. The stock actually closed down a bit, and that, right there, is the puzzle we need to unpack. Okay, so here's how we're going to crack this thing open. We'll start with that beat and a shrug, the numbers versus the reaction. Then we'll get into the real meat of it, the two-sided income story. From there, we'll look at what management is doing about it, shifting capital and cutting costs. And finally, we'll wrap up with our own analyst's verdict and a little something extra, a trade idea, just for fun, of course.
All right, let's kick things off with that headline performance because, honestly, on the surface, everything looked pretty darn good.
So, just look at these numbers. The outperformance on the bottom line is, well, it's pretty clear. Earnings per share, net profit, both came in way ahead of what analysts were expecting. Total income was more or less what everyone figured it would be. And that CET1 ratio, that's a key measure of the bank's financial strength, is sitting at a really healthy 13.3%. You look at this and you think, hey, that's a solid quarter.
And yet, this was the result, a little drop on the day. But here's the kicker. It was on above average trading volume. That tells you something important. It tells you investors weren't just ignoring the good news, they were actively selling, looking right past that headline beat and zeroing in on something else going on under the hood.
And this is where we find that something else. The real story here is a tug-of-war happening inside the bank's two main engines for making money. They are telling completely opposite stories.
So on one side of the rope, you've got this absolutely spectacular growth in fee income. We're talking up a full 12% from last year. That is a huge bright spot in this report, no question about it.
But pulling in the complete opposite direction is the net interest income. This is the bread and butter of banking, right? What they make on loans. And that core business is under pressure, actually declining year over year. Ding, ding, ding. This is the headwind the market was so worried about.
And you can see that strategic shift right here. Look at this. Fees now make up almost 20% of ING's total income. This is so important because it shows this isn't just some little side hustle anymore. It's becoming a serious, crucial buffer against all those pressures on their traditional lending business.
So, where is this NII pressure coming from? Well, it's a double whammy, really. First, you've got the ECB cutting rates, and that squeezes the profit margins for pretty much every bank out there. But second, and the CFO was really clear about this on the call, the euro has been getting stronger. And that actually creates a pretty big headwind when you're a global bank like ING, translating foreign profits back into euros.
But here's the really crucial part about that fee growth. It isn't just luck. This isn't just the market lifting all boats. Management is calling this alpha, and what they mean by that is it's stuff they are doing. It's structural. They're pulling in hundreds of thousands of new mobile customers, their investment trading accounts are growing like crazy, and they have this insurance business that they call a snowball, just starting to roll downhill and get bigger and bigger. Even their wholesale banking side had a record quarter for fees.
Okay, so that brings us to the big question. What's management's game plan for dealing with this tug of war? Well, it really boils down to two key things: shifting their capital to where it works hardest and keeping a really tight grip on costs. First up is capital. They are actively, deliberately moving money away from their wholesale operations and pouring it into their more profitable retail business. The part of the bank that you and I would use. They started at a 50-50 split, and check this out. They are already ahead of schedule, pushing past 53% on their way to a target of 55%. That's real execution. And second, costs. Now think about it. Everyone's dealing with wage inflation, plus they have to keep investing in new tech. Despite all that, ING is holding the line. They actually updated their guidance for the whole year, saying they now expect to come in at the low end of their forecast. How? By getting more efficient with digitization and even rolling out AI chatbots.
Okay, so we've weighed the evidence. You've got this awesome structural growth in fees on one side, but on the other, you've got these very real near-term headwinds on interest income. So, what's the final call on the stock?
We're landing on a market perform rating for now. Look, that strategic shift into fees is a fantastic long-term story, absolutely. But you can't ignore the market's current jitters about NII. It seems pretty justified for the time being. What we're really watching for is that interest income to stabilize in the second half of the year. Oh, and one more thing. That massive €2 billion share buyback they're doing, that remains a huge potential catalyst for the stock.
All right, now for the fun part. our final segment where we put on our thinking caps and explore a more creative way to play the dynamics we've just talked about. This is purely a thought experiment, but a pretty interesting one.
So the question is this: given that the market is so focused on the short-term pain instead of the long-term gain, how could you possibly structure a trade to capture that upside when the market finally wakes up? How do you bet on the good stuff while hedging out the bad?
Okay, so here's one potential structure. It's a paired trade. The main bet is on ING itself, maybe a long-term call option spread, something that gives you, say, 18 months for that whole fee diversification story to really take hold and get rewarded by the market. But here's the hedge. You'd pair that with a short position in a Eurobond ETF. Why? Because that's a direct bet against the very things causing the problem: a stronger euro and more ECB cuts.
What you're really trying to do here is isolate ING's alpha. That's the value from their good execution, from the macro beta, which is all the noise from interest rates and currencies that's dragging things down. In other words, you're betting on the management, not the market. And that really sums up the whole story with ING. It's a classic Wall Street conflict. A company playing the long game with a solid strategy, while the market is completely fixated on the next 6 months of headwinds. The big question is, when will that long-term alpha finally win out over the short-term beta? And of course, as always, this is not financial advice.